Hello and
Hey,
welcome
hey,
back to Crypto Talks. We're back again.
again.
We didn't actually. I don't think we expected to be alive today, but
We
here we
just
are.
did. Here we are.
Yeah, just suddenly we just appeared. It's all good. It's great. How are you, Rob? You good?
I'm splendid. How are you, sir?
I'm also splendid.
Splendid is good.
Yes. And hi to everybody in the chat. We
Yeah,
see you
good
there.
evening.
Weirdly enough, for some reason, Dave, I see you on my thing here, but I don't see you in this thing here. But we know you're there, Dave. Anyway, we're going to talk about the. Oh, now I can see you. Okay, we're going to talk about the CPI report that was released today. And also happy Valentine's Day, by the way, everybody. And happy, what was it again, Rob?
It's
Happy
Shrove Tuesday, Pancake Day here in the UK.
Pancake Day.
Pancakes.
It's more important.
So I'm
For
having
sure.
chicken.
Oh, okay. So we're having chicken pancakes.
No, just chicken.
So chicken pancakes without the pancake.
Yes, that's
Fantastic. Fantastic. Good job. Now, CPI. So the CPI was released. It actually, you know what? I'm gonna open it up here so we can see. Here we go. Last month, we had an expectation, I believe, of 6.7 for last month. I'm just gonna reiterate last month. For you, those of you who were there, you would have known. You would know this. So 6.7 is what was expected last month. It came all the way down to 6.5 from 7.1, which was a pretty big move down, to be fair. You can see this big chunk just whoop, right here in the charts. So that was good. Well, questionably good. And this month, we actually were expecting 6.3 from the 6.5 that we did have. So it was a very small expectation, small move. But we actually got 6.4. So we went, it came in hot, so to speak, even though it went down. And the reaction of the market was pretty. So it's divided because I'm going to open this up right here. Here's the crypto market. And I'm just going to show this briefly here. Here's the crypto market right now. So basically, I would say maybe 90% is up. And this is the top 740. We could change it to like the top 50 or something. And looking at it like this, basically everything except 2 is up in the top 50. Avi is down slightly, Stellar's down slightly, but Tron is up just slightly. But overall, it's up. So the reaction for the crypto market was up, right? I was a bit surprised by this. I could see the charts. What happened? We had a small spike first, and then it came down, and now it's going up again. And now, and then it went up again, and now it's going down again. So that's usually, you tend to get a lot of volatility when the CPI comes out. A lot of people tend to buy into it beforehand. Then when it comes, if it's positive, they hold the position. If it's not, they sell, usually. I try to avoid taking that risk personally, but sometimes we see that happening. So either way, we have the crypto market like this. Whoops, I need to fix that. There we go. Basically, everything is green. But then when we jump over to the stocks, and this might take a while for it to load, but suddenly everything is red, almost. We have NVIDIA and AMD is up. NVIDIA twice as much as AMD, basically. Tesla is up 4.5%. Synopsys and whatever that is up pretty heavily. But overall, it's a down day, right?
Yeah,
so
neutral to down.
I'm wondering, neutral to down. It's down. It's not down like heavily. It's not down 10, 15%, but it's down. It's mostly red. I wonder if there's a difference. Yeah. So, yeah. I'm not really sure why. I'm guessing the crypto market is just more speculators and more I think the people that are left in the crypto market right now, they just don't care.
It's kind of as we alluded to yesterday about, regardless of technicals, regardless of fundamentals, sometimes things go down for that long that they just need to bounce. And
Yep.
quite simply, for as the market has received the CPI number and it's come in, it hasn't come in significantly away from forecast. I would argue that's pretty much on forecast because, it's gone the direction they expected. But there's, as you say, the people that are in Bitcoin, that are in crypto, they're in now. They're not. The sellers have sold. The people that are going to disappear, the
Yep.
majority of them have gone, and so this is where we want to see that kind of decoupling of crypto from the traditional market, where it sort of
Yep.
shrugs off any bad news. It will still, if the stock market has a big red day and it dumps, then crypto will probably dump. But you want to see, the stock market be ranging whilst Bitcoin is in an uptrend, or the stock market in a downtrend whilst Bitcoin is ranging. Just that differentiation of behavior that says crypto is sort of ready to be a leading asset in the next leg of the move, as opposed to a following asset, which it has been for a significant amount of time. And that's been on the back of this macro backdrop, which is still affecting everything. But the market will do what it wants to do, and this could just pump for a day or two and then just dump straight back down and follow everything else, or everything else rebounds tomorrow and crypto has a nice big pump to take advantage of that move. And it essentially builds on what we said yesterday about how there are a significant number of short-term technicals that are looking good, and this is that it kind of goes against, in a way, what we have been saying about how the fundamentals will drive everything. That sometimes the market can just shrug off these fundamentals because let's face it, what was the news? Inflation came in roughly as expected. We know it's going down. They didn't expect it to go down as much. What's the real news story? There isn't one. It's just business as usual.
It's
the markets will move how they want to move on the back of it.
Yeah, I was going to say that, for the most part, the CPI report tends to be kind of a nothing burger in the short term. And it's like, okay, we see the trend. I think people are just wanting to see this trend. And if this trend now, here's the thing that I've heard some people talk about, that they were expecting it to go down to like 6, right? And now that it's down just 0.1%, what's going to happen next month? Is it going to be up 0.1%? And then suddenly people will start freaking out, saying, "Oh, it's reversing, inflation's coming back," and yada yada. Like, just calm down.
Well,
it's not that big of a deal. And I mean, we were kind of looking through the numbers here just before we started, and we didn't really have, unfortunately, we didn't have much time to kind of go through everything in detail, because we basically got on here half an hour ago. so we kind of just went through it real quick. But overall, let's see. So core CPI is down 0.1 as well. We have producer prices is down 1.1%.
See, to me that's more significant, because there's a marker of where things are going. That's that's a telltale sign.
Precisely. And I mean, import prices are up slightly. Export prices are down. Food inflation is down 0.3%. Energy inflation is up 1.5%, which is
very significant.
1.4.
That's the primary driver. Yeah, and I don't know in particular. I haven't seen any particular news stories about an increase in US energy prices. I know, here in Europe, we have had a kind of that. We had a much higher peak over the winter, but it's started to come down quite significantly now. So, I hadn't noticed anything to do with energy, but
just looking at this, just looking at this here, here's another view of it, right? So we have 6.4. This is CPI, and then we have core CPI here, 5.6. Energy is 8.7. Now, if I click into this, you can see that energy commodities is 2.8. Well, energy services is 15.6. If you click into this, we got natural gas being massively, it's there's quite a difference here. I don't think we can click into further than this, but no, we couldn't.
No.
But going looking at food at home is up total of 11.3. It's like these are the driving numbers, right? These two. So without this, the core CPI, but the core CPI moved the same as the CPI. So it's it's weird. Not weird, but services up 0.08%, which is not much, but it's up nevertheless. Rent is up. So yeah, it's we'll see what happens. But obviously the market short term, at least we know, is green for crypto, red for stocks. And from here, all we can really do right now is keep looking at the macro and see what the talk in the town is, so to speak.
Well, if you want to just take a quick look onto my screen.
Yeah, I was just gonna say, I see that you're sharing it there. There we go.
So, just as food and energy are the two things that we're talking about, and so here is wheat and natural gas as prices now. So we're right here, this on this green line is a year ago. So this is what the baseline for these CPI numbers are. Actually, no, this is January, isn't it? So it's there. So this is what the baseline is currently this is what we're currently working off. And if I just switch it to percent, go back to here. So based on a year ago, natural gas is down 38% on a year ago.
Yep.
Wheat is up 11%. Now, if we fast forward and if we go forward, say, 4 months, so we go to May, somewhere around here, then all of a sudden, from sort of that peak, natural gas is down 70% from that peak. Wheat is down 27%. So what we have to bear in mind is that the two biggest components of this high inflation rate peaked around, April, May, June. So these figures and looking at what happened from January onwards, because if you recall, a year ago there was several weeks of build up with photographs, satellite of the Russian forces moving towards the Ukraine border. So there was several weeks worth of prep where it was like, are they going to invade? Well, if they invade, what's going to go up? Wheat's going to go up. Oil and gas are going to go up. So you started to see that speculative buying, even into the start of the invasion, that peaked around June. So what we can expect to see is that those two big drivers of CPI are going to start dropping on a year-over-year basis very, very quickly, very, very soon, over the next 5 months. And that is going to tank inflation. It's going to really tank inflation because there's not much left. There's rent. Rent does contribute quite high, and rent is quite sticky. House prices don't move as fast as commodities do, but there's still not really that much overall driver of inflation left in the market on an annualized basis. And so the fact that crypto has acted positively on the back of a negative overall market is good. It's a good sign. But is it really a meaningful move in the big picture? No, I don't think so. I think it's simply we're still range bound. It was just a bounce up, a technical bounce following the support levels that we talked about yesterday, successfully holding. And if you want to know what we were talking about,
I can just do this.
Yesterday's video.
Yeah, I can just do this too.
But
we're right there.
That's from a technical perspective. We just bounced. The market hasn't really reacted either way, positively or negatively, in my opinion. And so oh my God, crypto's going to the moon because it was green when the stock market was red because the CPI came in hot. No, everything's just flat. It's just flat.
Yeah, yeah.
So
It's going
yeah.
to be. We said this before. I think I don't even know how many times. It's going to be boring. Short term is going to be boring for the most part. Midterm, we could see these pumps and then we'll come back down, and we can like I am personally expecting this range that we have right here from 18.7 to what is this 25 something. I would not be surprised if that was the range for the whole year. With some wicks down and some wicks up, maybe.
Yeah.
It's like I hope it's gonna stay in the bottom of that range for as long as possible because I want more stuff. But yes, you're absolutely right. Like we've had this retest, and it's bounced up now.
Yeah.
Not sure if the CPI has much to do with this bounce, to be honest. Zooming into like the 1 hour, you can see where the CPI was released, right? Can you see it?
Of course, you had a nice big wick down and then immediately a pump up.
So
yeah,
it was right here. Half an hour into this candle, it went whoop, and then it said, "Oh, actually, whoop," and then actually no, and now you're seeing it's continuing this hourly uptrend like this. We're not doing that's the general trend, right? So we're not doing TA now, but
no,
we'll see that's there.
Golden Goose asking, can we talk a bit about the new formula they used?
Yes, I
could talk a little bit about it.
I actually pulled up some info on it. Yeah.
If Phil knows, all I know about it is Phil knows about it. So
yeah, I know about it. To be honest, I didn't actually know that they were going to change this until earlier today.
Yeah, I didn't know this.
CPI is not something that I value as a very important thing at this point. Like I don't, if I think that something is very important to talk about and it's going to have a profound effect on the market, up or down or whatever, that's when I start to like really dig. I try to pick my fights, the CPI is not something that I care much about. But yes, they changed it.
So they've so they've changed the weighting of
yes,
each.
Precisely.
Yeah.
Yes. So basically, it says February 10 will mark the beginning to switch to yearly weights instead of 2 yearly. I think it was 2 years before. With the release of Lala in February, the CPI for new vehicles will introduce a methodology improvement to the time series filter that estimates the most recent cyclical trend and short-term fluctuations. Okay.
So just to say to go looking at the comment, what impact would that have, or what are they trying to achieve by using a shorter forecast? Well, I can think very, very clearly, which is kind of as I just sort of alluded to. A lot of things changed prices and got very uncertain around a year ago. If they have a way of changing the weights now so that it kind of excludes the pre-war inflationary bit. You've got two components of inflation. You've got the post-lockdown explosion in demand that led some inflation, and it's very unfortunate for Jerome Powell, because when he said it was transitory, he was correct. It just so happened that as we started to get that first peak come down, well, the war did break out and then sent commodities sky high, and so that's led to this sort of these multiple waves and this sort of ongoing inflation problem. So if they've I don't know, purely speculating, but if they've looked at certain things and gone, if we change the weighting from 2 year to 1 year at this point, then we can quite favorably drop inflation faster, then absolutely, that's typically what they've done historically, right? They've changed the formula multiple times in order to bring down the CPI value. Now they can talk around how useful it is. Useful to who is probably the question, because I know that our average inflation over the last year, I know in the UK it was 10.5%, the most recent print. Our inflation is higher than 10%. We all know this. Especially when it's when you consider the fact it's in depreciating currencies like the pound.
Actually, now that we're on the subject of this, I'd like to just kind of, for those of you who don't know much about what the CPI actually is and how it's calculated, the whole point of the CPI is to measure price increases or decreases of things,
A basket of goods.
a basket
So
of goods, right? So imagine if you went to the store and you were like, okay, I'm gonna go. A year ago, you went to the store and you wanted to buy food, and you started buying food. You always buy the same chicken thighs. You always buy the same steaks that you always buy because you like the brand and you think, oh, it's local. I like that. Da da da. Right? Great. Then suddenly, a year after, prices will be higher for the most part because of the way that our financial system unfortunately works. In my opinion, unfortunately, is my opinion. And what they do is that when prices go up, let's say if your favorite piece of steak, and the prices go up a lot, and people stop buying that, and they start buying cheaper meat because they can't afford the nicer, high quality meat, for example. Then they changed that item in the basket that they used to measure the CPI to what people are buying instead, which is a cheaper piece. So the inflation of it. Well, this is an example, obviously.
Yeah, well, as a good example, they changed it from, I think, steak to ground beef. So
yeah, precisely. So it's like, okay, so your $20 steak that you usually bought, or $30 piece of steak that you usually bought before, you can't afford this anymore because inflation is higher and prices are going up, and therefore you switch to a cheaper piece of steak from imported steak from in Sweden. We have local steak, which is Swedish, which is pretty nice stuff. It costs a little bit more, but then suddenly you have to start buying stuff from Denmark or from Belgium, whatever, which is cheaper, right? So you start buying that instead. So they change from the Swedish meat to the other meat, which is, let's say that costs $15, but it's risen to $20, and your Swedish meat has risen to $30. So they, instead of measuring the same item all the time, they switch to a cheaper one because people stop buying the more expensive one, and therefore the inflation is actually higher in the numbers than the numbers suggest. So people say it's cooked numbers, and I guess you could say factually correct. It is cooked, maybe not like because they want to cook it, they just don't do it right. It might not be malicious behavior. I mean, they might not want to.
I think it's pretty malicious. I'll be honest. I think it's
I think so too, but I like to give people the benefit of a doubt.
Well, it's
at least a little bit. I tend to try to see the good in people for the most part.
I mean, I can see seeing the good in people, and there's still calling a spade a spade.
I mean, dude, this is why you're having chicken today instead of pancakes, because pancakes are expensive.
Yeah. Flour is really so
expensive.
So expensive. Well, it's a lot more expensive than it was a year ago.
Right.
But yes, it is a fudge. It's a way of making the numbers seem and look better than they are, and it's not exactly a secret. So do I know for a fact that they're changing the weights in order to drive down CPI over the next year? No. Do I suspect it? Yes, based on historical precedent.
I would agree, for sure.
So,
but yeah, and Golden Goose says it too. Look, I think as far as I know, Golden Goose is pretty experienced in this space as well.
He's also a total idiot.
Don't call our viewers idiots. No, at least lucky we're friends. But yes, so it'll be fun to see how this unfolds, really. Like we said before, I mean, yesterday we did mention that we thought, for example, that we would move in like somewhere in like this range somewhere for the next week. And so far, so good. It's just been one day, but we'll see what happens.
Yeah.
So, and that's that. Honestly, I don't know. Do you have anything you want to go over?
Not really. As much as say, I was kind of hoping for some sort of big magic fireworks today, but it's as I've said, what we seem to have got is, yes, it's above expectations, but it's kind of on expectations. And sort of as mentioned,
Yeah.
if we look, it's the next 6 months, the next 5 to 6 months are the exciting ones in terms of where inflation goes, because it's going to go, especially on the back of today. I think what you'll start to see is this reflation narrative opening up, and people start saying, "Oh yeah, look, inflation's going to come back, and it's going to head higher." And absolutely, it's going to be. There's going to be multiple waves of inflation. Inflation isn't going to drop to zero and then just stay there, but it's probably in the short term going to go a lot lower than people expect,
Yeah.
because
I mean,
it's simply a reflex action of the fact it went up so high so fast, because you cannot make, unless you maintain this continual inflation, then it's a year over year measure. So if prices do not change over a year, the inflation is zero. And we've seen where most of the price raises happened. It was at the beginning of last year, not the end. So yeah, it's not going to it's going to keep on going down overall. This is
yeah.
just
I
it's a
mean,
bit higher for whatever reason. Meh. So what?
yeah. I would say this. Look. When we started seeing the downtrend, the first time here in July, the trend is down. Obviously, we had some big bumps here in September, October, November, and December. To be fair, and then we had some slow movements here in July, August, and September. Actually, it's October. Yeah. So we had some slow moves here for a while, but then it kept going, right? So we might see some slow moves here, maybe. I don't think
Yeah.
that we're going to see one of these things where it starts going up again, because there's been a lot of talk. What are the rates at currently? Well, right here you got 6.4. That's what it came out to be. So we can't really. I couldn't expect it to start going up from here. I'd be hard pressed to see that.
No.
And because
Especially with
the whole talk
with
from Jerome has been, right, we want to avoid that double peak. That's
yeah.
been his whole
Now
goal, right?
now in order to do that, if he's serious about that, he should already be thinking about lowering interest rates, because it's
Probably.
it's not going to take long now for the CPI to go below the interest rates for say over the next 5 6 months. And so what happens when we see inflation at say 4% and the Fed funds rate at 4.5, maybe 4.75? I don't know. I'm hoping that they start to hold rates now. I don't see why they really did a quarter point raise, most recently.
Yeah.
They could have held, and I think holding would have been the better course of action. So it's it's a fun sort of piece of trivia that in 2008, after when they hit the terminal rate of, I believe it was 5.25%, 5.25% in
Yeah.
July 2006, they didn't start lowering rates until July 2007. So they basically held it. There was 14
Yeah.
months between the
I'll share
last
this so you
price
can see it.
spike. Yeah. So going back to 2008, yeah, there
It's
was
right here.
yeah. So there was 14 months between the final rise and the first drop.
Yep. Yeah, precisely.
And in the process, what we had was, because we had the housing bubble. The housing bubble was formed from these years in the early 2000s of cheap interest and this increased availability of mortgages. So
Yep.
and so what we had was, you had these people are getting more and more credit on more and more over leveraged on more and more expensive houses, and then as the interest rates started to rise, it didn't really matter so much because everybody was locked into fixed terms for 2, 3, 4, 5 years.
Yep.
But it was during that flat period, more and more and more of those mortgages started to expire and went from the teaser rate of 2-3%, whatever it was,
Yeah.
up to
Yeah.
6%, 7%,
Yeah.
8% mortgages. And
And
that
things
is what
became
drove
painful
people.
really fast.
Yes, and that is what drove people under. This time round, we do have a housing bubble. This time we have the everything bubble. And
Yeah, I'll say this though, Rob.
Yeah.
The last time I checked,
Mm.
I believe, and don't quote me on this exactly, but I think the U.S. housing market is down 38% so far, which is pretty significant.
That's is that on sold prices? I don't think it's.
I
think it's more on number of offers and number of closures.
it,
So yes, what
yeah, I
what you
believe
start
yes,
to see.
exactly.
So what we start to see is we start to see the housing market bids dry up. Just the same as you see in the crypto market after a pump. You see the buy pressure dries up. There is nobody available to buy, and so then people start chasing down the prices. And so this is a huge rise in interest rates, very quick, into a market which, on the whole, is far more indebted than it was back in 2008. Although there's no specific driver in the same way. Like the housing bubble was very much driven by the housing market, but this time round, the US has something, I believe, like $9 trillion of debt basically set to mature, that needs to roll over and be refinanced with fresh bond issuances within the next 2 years. That was the number in my head. Now, some of that was already starting to mature, I'm sure, but 9 trillion. They're going to refinance that from 1%, 1.5%, 2%. They're going to refinance that 4.3, 4.5%, 5%. Like, that is
it's going to be a big ouchie.
It's a big ouchie, and that's for the US. How many other countries have got all these? How many corporations have got all this? How many consumers have got credit card debt? And this is going to hurt the longer and longer it drags out, the more pain it's going to be.
Yeah, for sure. I mean, in I can only speak for Sweden. With if I want to talk about exact numbers, I know that in Sweden we have much lower rates than we always have. With mortgages. Like when I got my house, our mortgage rate was 1.11%, and that was, it went lower than that even. At one point, it was below 1%. But now, when they raised it and people are panicking, it's only up at like 3.1. It's not really. I mean, 2.8. I think it is right now. It's not catastrophic.
My friend showed me mortgages he could get today, and he was getting around 4.2 to 4.3% offer on his mortgages. Now, my first house, I got on a 95% mortgage, and my interest rate was, even in 2015, when interest rates were much lower, mine was 4.8%, but it was £100,000 house. Now people are talking about £300,000, £400,000, £500,000 houses taking out. And interest payments that go from, or mortgage payments that go from £700-800 or €1,000, $1,000 a month sort of thing, up to 1,500 in a month as soon as that introductory rate goes over, and they cannot refinance cheaper. And the more expensive the interest rates are, fundamentally, as a pure function, the higher interest rates are, the lower the house prices are. The lower
and the less sales, even so.
Yes, and the higher the number of repossessions and foreclosures. It's and that's in every single stage of the debt market. What we have got a bubble in is auto loans, and that is a gigantic bubble, much smaller than the housing bubble, but compared to what it used to be, all that's happened is that the financial markets got burnt on housing, and they just went, what if we just do exactly the same thing again, but with cars? And so you have these collateralized.
We have a double problem right now.
Yeah, well, we have everything problem. We have the everything.
Yeah, but what I'm trying to say is, my friend who has his dealership, right? They had to raise their. I think we mentioned this before. They had to raise their rates for the car loans through Santander from, I think the best they could give before was 3.25% on a car loan, right?
Which is
and
crazy
that would be
cheap.
and that would be 100% of the car, not with any type of it's completely crazy stuff. Just people were just buying cars like mad. It was insane. But now, in the course, I think, of the first month where they raised it from 3.25 to 4.5 or 4.45, which is like, okay, that's a raise, but it's still pretty good for a car loan.
Yeah.
The month after, 9.95. Like,
Yeah.
okay, and now it's been stuck there for a while, so they just went all in, just boom. And you know, the people that in Sweden, you don't really have locked rates. You have adjustable rates that adjust every quarter. And so the people that now have these cars that they bought that were they could never had afford before, suddenly the cost of having that car went from like $200 a month to $900, $1,000 a month. And it's like, who wants to pay that just to have a car, like a decent car? No one. So the car prices have crashed already. The sales have crashed. Even even on ad sites, like in Sweden there's a site called Blocket. It's basically like Auto Trader, and the prices are just, they're tanking faster than the cars can even sell. Even if they, like a friend of mine, he put up his car for, I think it was like 11,000 for like it's a decent car, $11,000 for his car, and 12,000. But before he could even put it out, they had to lower it to 11,000. And then before they even got the first call, they had to lower it to like 10,000. Like, and that's in the course of like 2 weeks, right? So things are moving down pretty quickly in certain areas. But I wanted to show a question from Golden Goose here. I'm gonna switch this over to this here. So he says, as far as I'm aware, the Fed wants to reduce the CPI to below the fund rate. Once this happens, they are successful in stunting inflation, right?
Well, it depends on what they call stunting inflation. They've talked about this target of 2%. Now, for years, decades, 2% target
decades,
inflation. Now,
it's been a dream number.
Well, yeah, it's a number that kind of makes sense, I guess, but it's it's more about whether having positive real rates, so having interest rates which are above the levels of inflation. And yes, like ideally you would want to have the CPI below the Fed funds rate, yes, but you also don't want them to be going in opposite directions. So you don't want to be raising the federal funds rate whilst the CPI is crashing, because if you raise the Fed funds rate, that's going to continue to put downward pressure on that CPI. And if you then hold the Fed funds rate flat, then where's the CPI going to go? The CPI is going to drop, and it's then going to flatline. It's not going to marry up, and they're not going to sort of match. Ideally, you want them sort of following each other. And historically, that's kind of what we got. But this has been, because they were too late to the party and waited way too long to raise interest rates, they've had to over raise far too quickly, which is having the desired effect of crushing inflation, but it's doing it by crushing demand, essentially inciting a recession.
Jerome has been saying he wants to destroy demand, and which is he's succeeding, but it's like, but I hate the fact that the goal is to destroy people's lives to a degree. Like,
the irony is, the irony is that the Fed has two mandates. One is to control inflation, and two is to manage unemployment rate. Now, Powell is talking about destroying demand in order to lower inflation, but demand destruction also raises unemployment. So they will be watching the numbers. They're watching the numbers very, very closely, because right now the economy is still adding jobs. The economy is slowing down overall, but there's still pent-up demand that wants to kind of get out there. And until that pent-up demand is gone, then until that pent-up demand is gone, there will not be that raising in unemployment, because you have to destroy the demand. Then you have to wait for a while for business owners to become distressed, and then they end up getting laid off. Now, that's something that can have quite a big lag. And if he sits and holds the Fed funds rate, waiting to destroy the economy, well, then by the time you notice the numbers, by the time you notice the layoffs, it's already too late, because you've already started to put the market into this stressful scenario where it's in the downtrend.
Yeah.
And it's the numbers that they seem to be following. It's like they're kind of programmed to chase. They're programmed to be behind the curve, and so they're always set up to take it too far in one extreme or the other. And it's almost like there should be some sort of computer that does this instead of a bunch of guys in suits that don't really
with agendas.
really know what they're doing. Well, you say we could call it an agenda. He would call it a mandate. He has a job to do. He has an absolute target to
sure, but is he
maintain
hiding
inflation.
behind that, or like?
Well, no, because what he's doing, he is doing exactly.
I'm
what
not saying him. I mean the system is kind of, I don't want to get into all that.
the system
I'll start
sucks,
sounding
so-
like exactly. But let's see. Golden Goose says 4% is the new 2%. Most likely.
maybe.
in my-
Is it?
I'd say this. I think. Whoops! I totally drew on my chart. I think they changed the terminal rate to 4.5 rather than 5.5 or something like that. Again, I don't keep track of this as much as maybe I should, because I don't believe that the CPI is, and I don't think the CPI is as important, and I don't think the Fed funds is as important as people might think it is. But either way, I could definitely see this stopping at like 4.5. One more rate hike and then leave it at that, and then just holding it for a while, maybe throughout the year, right? And see what happens. I don't think it's a good idea to start. We don't want to have this happen. This big spike up and a big spike down. I would like to see it kind of just calm down,
Yeah.
It's like describing Anakin Skywalker in one word or one sentence. Calm down, Anakin. Just calm down. Let's hold it here, see what happens. Let things kind of smoothen out, get that soft landing that people want. And I don't want to have to see a huge, when things crash suddenly. I don't want to see that spike down to 0 just to save face again.
Yeah.
Let's keep it here, and maybe they would just go down to and make the new, maybe mean reverts to, let's say, where it was in 2004 at like 1%.
So
maybe that's the new bottom instead of 0.
So what I think, if you want to just put my chart on for a second.
Mm-hmm. Yeah.
So this is something I've just been playing with. So this in the orange line is the total US federal debt.
Yep.
Okay. So it goes on the left. You see it currently tops out at 28 trillion. Lovely, nice exponential rise there.
Looks like a Bitcoin bull market.
Well, it kind of is in the sense this essentially is the reason. If you think that Bitcoin is going to go down, you expect this orange line to also go down. Essentially, is the thing. Now, more importantly, though, is the white line. The white line is this value, the total US debt multiplied by the federal funds rate. So, just as a very rough guide, this isn't a precise thing, but if the federal funds rate is what dictates how much essentially US bonds, what their interest rate is going to be.
Yep.
And so, roughly speaking, in fact, we can have a look at the US 30-year yield. So the US 30-year yield is currently at 3.975%, and the Fed funds is at 4.3, so not too far away. So what this white line then becomes is essentially the interest payment per year on US government debt.
Yep.
And that's a scary number. That is 1.22 trillion is the current number on that number.
That's the debt servicing, you're saying?
That is the cost
That's
of
servicing
just
cost. Yeah.
servicing the debt. Yeah.
Yeah.
And if we look, we have this kind of increasing trend line of in 81 it was 170 billion, in 89 250 billion, in 2000 360 billion, 440, then 520.
Question.
Now we're at $1 trillion.
Question.
Yeah.
What happens if you take into account the M2 money supply as well with this?
What's as in divide? So what? So see what
Yeah.
the
Yeah.
debt
So
is
you
as a
remove.
proportion.
Yes, you remove the inflation out of the
What's
equation, basically. Okay.
of the money supply. So the US owes 6% of the money supply in interest on its debt per year.
Great. That's fabulous.
Can anybody tell me where it's going to get 6% of the money supply from?
Well,
Anybody?
it's
Because-
very easy. All they have to do is print 6%. More money.
Ta-da!
It's
And
just ridiculous.
there we have the answer. And so this ultimately is the question: is do they have 1.2 trillion a year to service the debts? Hell no. That is around 50% more than the US military budget. It's a humongous amount of money to pay out.
Brr. Money printer go brr.
So money printer go brr, and ultimately what that money printer is going to have to be accompanied with is a reduction of interest rates, because the US government cannot handle this debt burden with these high interest rates. And so what we've had this growing debt over the noughties, so over the 2010s, so since the great financial crisis. But we've had relatively low inflation. I know, we've talked about manipulated numbers and things like that, but inflation has not been a primary concern of people in developed nations for most of the last decade or more. It's been a problem in other countries, and the US, the dollar is a big part of that. But now we're seeing a problem where the US itself has a debt servicing problem. But and there is a way out, and it is the money printer.
Yep.
So it's a return to, do we think that over a 3, 4, 5 year period that they won't print money to get out of this mess? Of course they will. Because
they have to.
The other option is to continually entice people to pay to buy this debt, which they clearly can't afford, and they have to offer higher and higher interest rates in order to entice people to buy more and more of this debt.
Yeah.
And
or hashtag
not
Bitcoin
going to do it. Well, this
it's not that simple.
It kind of is that simple, because if you look at this scenario and I go, well, the US defaulting on its debt is terrible for the dollar, and the printing of money, the debasement of the dollar, even though it's not going to necessarily lead to a weakening of the dollar, it will lead to a weakening of foreign currencies because they are much weaker than the dollar. But the debasement of currency is basically the single biggest marker on how much Bitcoin will appreciate. So either you think that magically the US are going to generate a shitload of money and be able to pay their debts for the first time in, well, as you can see on this chart, decades, or you think they're going to default, in which case the dollar crashes and the whole global financial system collapses, and what do you want to own in that said state? Or they're going to money print and they're going to debase the currency. So I mean, either everything falls or Bitcoin goes up.
Yeah, it's like, where do you think? I mean, I'm asking the general public here. When they turn on the money printer and they have to print 6% of the current money supply, right? Where do you think that money will end up? Where will people take their money and escape? Right?
That's the question.
One of the big, one of the big gorillas of that escape is going to be Bitcoin. I am pretty sure, because we know that it's the hardest money that's ever been created or found, or whatever you want to call it. why wouldn't it be there? It will certainly go into investments, into stocks and all these things, because people like to speculate and they like to, make some profits. But Bitcoin is kind of more of a I think a lot of people that really know Bitcoin understands that it's more of a an escape from the system rather than to make you more money.
It's an insurance policy.
Yeah, exactly. Thank you. That's a pretty good word for it.
It is an insurance policy against the financial system, and its aim. Well, it always say it doesn't have an aim, and people would always talk about Bitcoin being a protection against inflation. No, it's not, because inflation is not. Inflation is just the price of stuff going up. Bitcoin is a protection against monetary debasement. That is the big difference, and to that aim, it is incredibly successful. Now, we haven't had any monetary debasement now for a year and a half. If we just look at the money supply, money supply has been flatlined since. Well, yeah, it peaked here, March 2022. So for nearly a year, we've had no increase in the money supply. So Bitcoin, that protects against an increase in the money supply, hasn't done well. That's not surprising. And looking back at over the rest of Bitcoin's history, it's never had a period in its history before where the money supply hasn't been increasing. Ever.
I mean, just look at that. Look at the peak of Bitcoin happening just before the peak of the money supply, where the printer stops going brr, right?
Yeah.
And it's uncanny. It's right there. And see how it started again, right where your line is, right there. It's like, okay, let's print some money. Boop. Bitcoin says, okay, whoop, straight up. And it's just, it's pretty simple if you look at it that way. Really, it's like, okay, I'm just gonna hold and save up some dry powder, and then once they turn on the printer again, I'm gonna buy then. Why not, right?
Yeah. And that's simply the money supply has increased by 37% from COVID.
Yeah.
And in that time, Bitcoin appreciated by 16. It went from basically 5, 6, 7, 8,000, depending on the day that you choose of the COVID crash.
So basically went up.
That kind of range to set to currently at 20 something thousand. It went up 5x.
Yeah, to where it is now.
So that is the twin function of the protection against monetary debasement, as in the fact that there was more money being pumped into the system. Bitcoin captured an above. It captured more than its allocations worth. It captured more than its fair share, and it took a bigger jump, accompanied by that adoption growth, that those new users coming in. And then that sort of following of Metcalfe's law, that the more users of a network, the more valuable that network becomes. So you've got these two monetary debasement and adoption curves that are both pushing alongside each other. Now, the monetary debasement side isn't working for us at the moment, but long term, the path is fairly clear based on what little options they have, and the options that J Powell has are none and fuck all. So
Rob, how much did you say it went up?
Two options.
How much did you say the money supply? 37% in money supply?
37%. So it's around 15 trillion to 21 trillion.
So Bitcoin at the same time went up 1,740%, 41 even. At that point, from top to bottom, from the bottom to the day. I'm just grabbing the big measurement there. But hey, it's like you said too, the Metcalfe's law thing. If we look at the rainbow chart, which I kind of like to look at because it looks funny, if it keeps following this curve, by the halving, if it stays in the bottom range of this in the halving, it will be worth somewhere between 22 and 29k if it stays in the bottom range here.
Yeah,
like that's.
I'm still.
I don't
I am
want to use this as a prediction thing. This is one of those
no.
things where I tend to buy at the lower range and I tend to sell at the higher range. That's kind of how I use it.
My gut feeling tells me that just that belief, and maybe I'm wrong. I have been wrong once or twice in the past. I really do fancy a break to the new all-time high before the halving, just to piss everyone off, and then a total collapse in 2024. That would just be like so Bitcoin.
That would be so Bitcoin. Yeah,
It would be so Bitcoin.
you're right. And I mean, looking at the rest, I'm just going to go over this very quickly. And I think we're going to round it off after this. MBRV is outside of the buying range or bottom range. It's retesting the green there. I don't know if you can see it.
And historically, that's been a generational buying opportunity.
Yeah, so you've seen his here from the top, just gone down, and now it's been sitting down here for quite some time. And that's the MBRV score. Pure multiple, I think, is outside of it right now. The rodal ratio is inside of it still, just ever so slightly. And the unrealized profit, the Nupal, is outside of it too. So it's like, okay,
it's just
I don't know what's going to happen here.
If nobody knows what's going to happen, but Jesus Christ, look at that map. It's if there is ever a screaming, just bloody buy it and wait for several years, it's these sort of charts, man. Like they all just scream the same thing.
And by the way, for those of you who have never seen these before, this is the cbbi.info. So it's actually colintalkscrypto.com /cbbi. And it takes into account the pi cycle top, the Rupal and Nupal, the rodal, the pure multiple, 2-year moving average, Bitcoin troll trend line, which is the rainbow chart, the MBRV, the reserve risk, and the Wubel top cap versus CVDD measurement. And then it kind of scores it from 0 to 100. 100 has been kind of where the peak has been. And except for this peak here, I'm not sure why. Maybe they need to adjust these numbers, the way they calculate this. But generally speaking, when it's down under 10, like it's not a bad time to buy. I see here under 10, we're in this bear market bottom. Under 10, we're a bear market bottom. Same thing here. So I like to look at this, but I do enjoy even more just looking at these themselves like this.
As another similar website, buybitcoinworldwide.com is one which has an awful lot of charts on that's very very nice. Shows things like cycle repeats and an idea of where things are going, where they've been, mining data, hash rate. Very good.
Or you just come here and watch this and we talk about that stuff.
Well, we do that too.
Much easier.
Everybody.
And much more fun for us, especially. All right. So I think we're going to round this off here. It is Valentine's Day, so I'm sure people have places to be. So we're going to end this here. And thanks for watching. And remember, as always, like, subscribe, and hit the notification bell, and all these things would be appreciated. And don't forget to join the Discord too, because we have these discussions literally all the time in the Discord. So
we'll have them. We'd like to have them with an audience. And also remember, do not buy Bitcoin because two baldies on the internet tell you to.
Yeah. Don't listen to us.
We're not telling you to.
We're not telling you anything. Don't do what we say. Listen to what we say and then make your own mind up, and then you can go and do whatever you want. Okay, cool. Okay, so we're gonna end here. Thanks everybody. See you next time.
Bye all.
Cheers. Bye.